Here's the other part.
I said the Dow's going to go to 6,000 over the fiscal cliff.
You said we had a European sovereign debt problem. Spain was likely to be the larger trigger.
Oh, yes.
The fiscal cliff was going to be one of the contributing factors, and we were going to go down as a consequence.
Factor, short term.
Okay, I mentioned both things, Harry.
Ron, argue something real here, okay?
I'm happy to argue something real. Corporations have $1.7 trillion worth of cash. Banks are as well capitalized as they've been in 50 years for the market to continue going higher. Price-earnings ratios are very fairly valued at current levels. In fact, maybe even a little undervalued. The economy's growing. Real estate's turning around. Manufacturing's coming home. We're in an energy boom. Most things are going right with the economy and will continue to do so. And the markets are telling us that by going up and doing things in tandem without any glaring divergences that would warn us otherwise.
Okay, let's do this. Let's have each of you now address the other's argument. Harry, Ron's pointing to improving fundamentals for the U.S. economy right now, especially at the corporate level. What do you agree with that?
We had improving fundamentals from 2002 to 2007. Stocks bubbled up, yes, and then we crashed.
All right, but now
we have it again. Of course, they're improving. They always look good at the top of a market. Fundamentals do not deteriorate. The markets start to crash ahead of the fundamentals. And again, I don't think they're going down yet.
Okay,
I think the fundamentals are good right now.
Ron, Harry says we're on an unsustainable debt accumulation phase right now.
Budget deficit is coming down as a percentage of GDP. Will continue to do so. So we're likely to get some sort of resolution on the budget. It won't be what we want. It won't be Simpson Bowles. But if you look at what happened today with the banks in Europe, which repaid the European Central Bank more money than thought was possible in only a year on a 3-year lending facility, Europe is actually, although it's going slow, healing itself. The U.S. is actually in very good shape. If you take the government out of the equation in terms of its percentage of GDP, Ed Yardeni, very good economist, notes that the private sector economy last year grew 3%. Profits will continue to go higher. And yes, the markets do peak ahead of the economy, but we're not seeing the types of divergences that we saw in 2007 and 2008 that would lead anyone to worry about, one, the market, or two, the economy.
Harry, do you want to rebut?
Yes, we started to see those divergences in mid-2012, but QE3 changed that. I agree with Ron. We are not seeing those divergences either. That's why I'm not saying it's going to happen now, and I'm going to be looking for those divergences probably somewhere in the second quarter. We probably go up higher here for a while. We see another correction. It's on the last rally that you start to see the smart money selling and buying pressure go down and selling pressure go up.
And we have not seen that yet. Top at this point right now, Harry? I mean, if you see the top occurring at the second half of the year, what would prompt the smart money to start selling at that point, do you
catalyst.
think?
Okay, I'll tell you one thing right now. Again, look at the stock charts. This is the clearest pattern I've ever seen, a megaphone pattern, as I said before. Each bubble to new highs. If you draw a trend line through the 2000 top and the 2007 top into now, you're going to hit that later this year at 1,600 on the S&P 500. If I'm a smart money person, a technical trader, I'm going to say I'm going to short here, and then the market's going to have to really push above that before I'm confident. That's one thing.
It would be a technical prompted sell-off, not a fundamental one then.
The second thing you see, I think, that could do it, we have massive stimulus. I mean, the Fed keeps upping the stimulus. QE3 was bigger than QE2. Japan they're stimulating the equivalent of $3-4 trillion a year, given the size of their economy. If we keep seeing up and up stimulus and less response in the economy, then people will lose out. Now, to me, a question Ron said earlier, $1.7 trillion in balance sheets on companies, that's a sign something's wrong. Why would companies not be investing free cash if they were so confident that this recovery is sustainable?
Do you want to have the final word there, Ronnie?
Last word, Ron.
Well, listen, I think that the Bank of Japan, by stimulating as much as it's doing, means it has to buy Treasury bonds to manipulate its currency lower. That means interest rates stay down, with or without the Fed. China's going to do the same thing. So is everybody else. There's nothing yet that tells me that anytime in the next 1, 2, or 3 years, we're going to have the types of trouble we've seen in the past. It's just not setting up the same. This economy is in much stronger shape than it was pre-crisis and not vulnerable yet in any way to the things that Harry's described.
It's in strong shape because it's had trillions and trillions of dollars of crack, and it's in a coma.
Policy matters.
Okay. How long
can you do this, Ron?
For as long as it takes.
They're going to have to do this for another decade.
And we don't go into depression.
We'll try and
we don't crash.
Right, and you end up in a coma forever like Japan.
Look
at Japan's
Let's agree to disagree on this one.
22 years later.
And we're up in 3 years. We're up in 3 years from the low to new all-time highs.
Ronnie, thank you. You can continue the conversation later
try
on
and save
over
the
a
tape
drink.
this time.
It is Friday night after all. Okay. What else?